Okay, so I'm going to show you a real deal we have under contract right now. We just tied this one up last month. It's in Denver, Colorado. It's a 309 unit property. So the partners involved, this is a joint venture between Elkstone Capital, Hotel Shift, and Voyage Capital. Voyage Capital is a hotel developer. They've built over 100 hotels. Hotel Shift, it's in the name. They're the ones who they didn't create this model. There's definitely other funds that are doing this. It is a very niche strategy inside of commercial real estate. And then us, but across the deal team, 235 million in AUM, 40 years plus combined experience. Currently 22 properties under management and a full cycle IRR of 27%. So Nate already gave the general disclaimers. I don't think I need to explain the cap rate arbitrage to you guys because I kind of already did. To people who are new to this concept, I show them this. So 2 buildings, they're exactly the same down to the granular level. One's a hotel, one's an apartment. Which one's worth more? The apartment, right? Because because of what I explained, the apartment's going to trade at that lower cap rate. I already explained kind of why the hotel conversion strategy. We don't take entitlement risk. A lot of the times we have to rezone the hotels to multifamily, and that can be a 5-month process. So we never let earnest money go hard, and we never close until we've got rezone in the jurisdictions we do this in. We only do hotel to multifamily conversions. There's a lot of other types of conversions. There's office to residential. I saw one that was like hospitality to self-storage. That was a really weird one. I've seen warehouse to office. We just do hotel to multifamily. And again, as I mentioned, we want to be the best price units in the market. So we're typically, it depends on the market. The one we did in Houston, we're pricing those at $875. These ones in Denver's a lot more expensive, so these studios will charge $1,150 per unit. And believe it or not, in that price range, they are 100,000 units short in the Denver market.
Wow.
At the $1,150 price range. So that's kind of our thesis for this. So this is the property. It's an 11-story Holiday Inn. It will be delivered to us with the flag removed, and the seller will pay liquidated damages to remove the flag. The owner is a big asset management company out of New York named Monarch, and they actually picked this property up via foreclosure about 4 years ago. So they had a debt fund. They had loaned on multiple hotels, and this hotel's been struggling. Despite doing $6 million in top line revenue, they still can't break even. And that's the story with a lot of hotels right now. And that's where we get to come in and negotiate an awesome price because no other hotel owner can make this deal pencil. But as a multifamily operator, we know we're going to convert this, and it's going to be worth several more million than we can buy it for after we're done. So we can take that risk and we can buy them out. So we got this under contract for just $29,000 a door, $29K per key. It's $9 million purchase price, but we're putting $10 million into it. So it's a big lift because we have to put kitchenettes in all the units. So after fees, our interest reserve, and all is said and done, it's a $23 million all-in cost. We're starting with 309 units. We'll actually end with 240 because we're knocking out some walls so that we don't just have pure studios, but we'll also have some one-beds. Diversify our unit mix a little bit. And this one's interesting. We're actually going to hold it for 10 years. The reason being is because this sits in an opportunity zone. Does anybody know what an opportunity zone is? Mm-hmm. Cool. I wanted to bring that up because, yeah, you guys especially, that's a way for somebody who is exiting a business. They can classify the goodwill portion of their company. Let's say they sell a business for $10 million, half of that's considered goodwill. That $5 million they can roll into this opportunity zone business within 180 days. And if we as the operator hold this business for 10 years, that investor gets a step up in basis on the value of the real estate, and the capital gains are essentially forgiven. So they don't pay capital gains. So that's why opportunity zones are extremely powerful. I love that you're nodding your head because you know the strategy.
Dang.
There's a couple of things you have to do. You have to pass a substantial improvement test. So we're buying the building for $9 million. Let's say the land is worth $3 million. So 9 minus 3 is 6. So let's say the building value is $6 million. The substantial improvement test means we have to improve the property by equal to or greater than the building value, which we are. We're putting $10 million into this. So we're definitely improving it by more than the building value.
Interesting.
And the reason for opportunity zones is because they're government census tracts, sometimes state, and it's because that area is economically burdened in some way. The area median income might be lower than average, and so they want to stimulate growth. So they're saying, okay, you come in, help us stimulate growth in this area by developing real estate, helping us get more businesses, helping us create more housing, hold it for 10 years, and we're going to give you a big fat tax incentive. So this is what the hotel looks like. Actually, let me go back to the area real quick. I skipped over this. This is where we sit. So it's a fantastic area. Denver downtown is 18 minutes away. Denver Airport is 20 minutes to the northeast this direction. You can see there's a Walmart, a Sam's Club. FBI's Denver headquarters is right across the street. And then United Flight Training Center's headquarters is right across the street. They're training 3,000 flight trainees at any given point right across the road from us. So that's also part of our thesis. We think a lot of these people are going to come grab studio units.
That makes sense.
And yeah, this is what the hotel looks like. It's actually in really good condition. So we're going to strip out the carpet. We're going to put in laminate flooring. We'll install kitchenettes in every unit, new cabinets. We're going to add a golf simulator. We're going to update the fitness facility, make it look really good. This is what the kitchenettes will look like. So we've got two kind of color schemes, but they'll be cute. It'll have everything somebody needs to survive out of a studio.
So happy they're going to be cute.
Yeah, out of a 350 square foot studio. And believe it or not, for $1,100, that's a great deal for Denver. Here's our business plan. So those first 2 months, we're knocking out walls. Months 3 to 9, we're combining units. We have to install fire sprinklers in the corridors to be up to code. We're going to repair the parking lot, do the kitchenettes. Months 13 to 28, we're starting to lease units. We think we can do 15 leases per month. And then by month 30, we're projecting, based on our pro forma, that, so again, remember the total project cost is $23 million. We think our stabilized net operating income will be about $2 million. At a 6.5 cap, that's a $30 million plus valuation. So we just created $7 million that now we're going to go get a bigger loan at month 30. We're going to pull all that out, return that to investors. We think we can get investors 90 to 100% of their initial contribution back. And as you know, a cash out refinance is considered debt. It's not taxable, right? And then our investors stay in the deal, and we hold until we get that QOZ benefit.
Can I just ask one little question? So
Yes.
what would be a downside in a scenario like this? Because you have a construction, right?
Great question.
There's no labor, huge labor shortage in construction. Like, can you explain that?
Yeah, two biggest risks. You just hit one of them, construction risk. What if our budget is actually 12 million instead of 10 million?
Yeah. Or double the time.
Exactly, or lease up risk. Instead of leasing 15 units a month, what if we only do 10 a month?
Yeah.
Just right there, that adds on another 8 months to our leasing timeline. So that's going to push out that refinancing timing. You're absolutely right. So this is where we lean on people who are smarter than us.
Yeah.
So we go to Asset Living, very large third-party property management company in this market. They already manage tons of units. They have a really good pulse on the supply and demand. They're helping us, they're informing this number.
Yeah.
And then on the construction side, Voyage Capital, they have an internal, so they're one of the 3 partners in the deal.
Yeah.
They have an internal general contracting company that builds hotels.
Okay.
So they're going to do the development.
Yeah.
We're still sending out an RFP to market to keep them honest. RFP stands for request for proposal. So we're going to get other bids. As long as they're not drastically higher than everybody else, we're going to use them.
But what's your recourse then?
And we have a contingency on the construction budget. So really, we think we can bill it for 9. So we have $1 million in pure contingency. So that padding helps.
Okay.
If that makes sense.
That's how you think about it, okay?
Yeah.
Sounds like an interesting deal.
Yeah. So to finish it off, you guys, if you just look up Developing Denver on Instagram, they actually have some cool videos on the project. The journalists found it through our city submittals. Again, it's in great condition. They just renovated all the bathrooms 4 years ago as a required property improvement plan they had to do for the flag. And target returns, we're projecting a 3.5x multiplier to our investors over 10 years. So if you put in 100 grand, we anticipate getting you back 350 grand. And that works out to about a 23% IRR. So I won't bore you with all the numbers. If you guys or know anybody, or if you're interested yourself, I'll send you the deck. You can jump into some of our underwriting assumptions. I think we're very conservative on our OpEx ratio. We're running 47% on our expenses. If like a Class A building in Salt Lake City should run 35% on expenses. Pretty much assuming 3% rent growth. We're not assuming any rent growth in the first year. And then I've got some information about our bridge loan that we're getting.
What's the economics for investor versus the team?
For the LP?
Yeah.
Yeah, like I said, just 3.5x your money over 10 years.
What's going to the GPs?
Oh yeah, great question. So we've actually dialed this back. We're taking a 2% acquisition fee. So that's on project costs and purchase price. So that'll come out to like 350 grand. We're actually not taking a disposition fee. I need to update this. So we're just taking a 2% fee up front and then a typical asset management fee, which is a flat $5,000 a month. Usually a lot of operators will do 2% of gross potential revenue per year as in the form of an asset management fee. And then our promote, we have promote.
Yeah,
So the waterfall, let's see. So we're doing a 8% preferred return to investors. So once you've made 8%, then we jump into an 80-20 split territory. Yeah, LP's 80, GP 20. And then after you've made 20%, then 50-50 on any dollars generated above and beyond a 20% return to you.
So what's your projected vacancy rate? I assume that changes by time.
We're underwriting 7% between economic and physical vacancy. So our occupancy would be 93%.
So you're assuming 93%? Mm-hmm. Steady across all years? Or?
Steady across every year after stabilized. So obviously there's no income for the first 30 months.
Overall vacancy rate for Denver and Metro?
It's different for every asset class. For Class A, it's probably going to be higher than that right now. But again, we're in workforce housing, so that's why we feel like 5% physical and 2% economic is realistic.
Okay.
That's all I got for this, guys. Any other questions about the deal?
We'll follow up with Mitch and then give him a round of applause. Thank you.
Thanks, bro.